Imagine this. A government announces it's printing hundreds of billions of dollars. Markets panic, headlines scream, people argue online, and you're told very calmly, this will help the economy. But here's the uncomfortable question. Almost no one asks out loud. If new money is created, who actually gets it first? Because it's not you, not your parents, not small businesses, not workers waiting for wages to catch up. The truth is quieter, and once you see it, it's hard to unsee. Right now, governments around the world are running record deficits. Debt levels are at historic highs. Central banks are expanding balance sheets again. This isn't theory, this is happening now. And most people still think money printing works like this. The government prints cash, it spreads evenly through the economy, everyone feels a little richer. That story is comforting. It's also wrong. Let's rewind and slow this down. When a government says it's printing money, it usually doesn't mean physical cash. No trucks, no ink, no pallets of bills. It means numbers appear on a central bank's balance sheet. That's it. New money enters existence digitally, with a few keystrokes. But here's the part that matters. That money does not enter the economy everywhere at once. It enters at very specific doors. And whoever stands closest to those doors gets paid first. Let's walk through the process step by step. The government needs money, maybe to fund a stimulus, maybe to cover a deficit, maybe to stop a financial crisis from spiraling. So it issues bonds, IOUs. Banks, pension funds, insurance companies, and large institutions buy those bonds. Then the central bank steps in. It says, we'll buy those bonds from you. With what money? New money. Money that didn't exist yesterday. The central bank credits the seller's account. Just like that. No taxes collected, no savings used, new purchasing power created. So who just got the money? Large financial institutions, banks, asset managers, primary dealers. Not because of corruption, not because of conspiracy. Because that's how the plumbing of the system works. This is where things start to feel strange. That money doesn't go to grocery stores. It doesn't go to rent. It doesn't go to wages. It goes into balance sheets. And balance sheets look for returns. So where does the money flow next? Stocks, bonds, real estate, private equity. Anything that can absorb large amounts of capital quickly. Asset prices rise. Not because the economy suddenly became more productive, but because more money is chasing the same assets. This is why markets can soar while everyday life feels unchanged, or worse. There's a name for this effect, but you don't need the jargon to understand it. Think of money like heat. If you heat one side of a metal rod, the heat spreads outward, but the side closest to the flame gets hot first. By the time the heat reaches the far end, the shape of the metal has already changed. Money works the same way. Those closest to the source feel the benefit early. They can buy assets before prices adjust. Everyone else gets the money later, after prices have already moved. Now let's talk about wages. Wages are slow. They're negotiated once a year, sometimes once every few years. Asset prices move every second. So by the time new money reaches workers, housing is more expensive, stocks are higher, education costs more, healthcare costs more. Your paycheck might rise eventually, but your purchasing power often doesn't. This is the part no press conference explains. Money printing doesn't make everyone richer at the same time. It rearranges who benefits first, and timing matters. Now zoom out. Why does this system exist at all? Because it's fast. When crises hit, governments can't wait for tax reform. They can't wait for productivity gains. They can't wait for political consensus. Money creation is immediate, and in moments of panic, speed matters more than fairness. During financial crises, this system has prevented total collapse. Banks stayed open. markets stabilized, credit kept flowing. So yes, it has benefits, but there's a cost. And the cost is subtle. Over time, repeated money creation shifts wealth toward those who already own assets. If you own stocks, real estate, or businesses, money printing often helps you. If you live paycheck to paycheck, it usually doesn't. This is where the irony creeps in. Policies designed to support the economy often end up inflating asset bubbles. And when those bubbles burst, the same people who didn't benefit much on the way up pay the highest price on the way down. Now let's address the obvious question. Why doesn't the government just give the money directly to people? Sometimes it does. Stimulus checks, benefits, emergency transfers. But even then, the timing still matters. When checks arrive, prices have often already adjusted. Rent doesn't reset downward. Housing doesn't suddenly become cheaper. Stocks don't rewind. Direct payments help with survival. They rarely build long-term wealth. Meanwhile, assets bought early continue compounding. This isn't a moral judgment. It's mechanical. Now let's talk about inflation. Because this is where the confusion explodes. People are told inflation is caused by too much demand. Sometimes that's true, but money creation adds fuel, not evenly, not immediately. It slowly pushes prices higher across the system, and inflation acts like a quiet tax. It doesn't show up on a bill. You never vote for it. It simply reduces what your money can buy. So when governments print money, they're not just choosing who gets paid first, they're choosing who absorbs the loss later. And that loss is spread across everyone holding currency. Savings lose value. Cash loses power. Debts become easier to repay. Assets become harder to afford. Notice the pattern. Debtors benefit. Asset owners benefit. Cash savers don't. This is why governments with massive debt have a quiet incentive to tolerate inflation. Not hyperinflation, just enough. Enough to erode the real value of what they owe. Again, not a conspiracy, just math. Now let's zoom out even further. Globally, when a major country prints money, it doesn't stay within borders. Capital flows across markets. Currencies shift. Emerging economies feel pressure. A decision made in one central bank meeting can raise housing prices on the other side of the world. This is why global inequality can widen even when growth looks strong on paper. The system rewards proximity to money creation, not effort, not productivity. Proximity. Here's the quiet absurdity. The people least aware of how the system works are usually the ones most affected by it. And the people closest to the system rarely talk about it publicly because it sounds technical, boring, complicated, but it's not. It's about timing, access, and ownership. So when you hear, the government printed money, don't imagine cash raining from the sky. Imagine a door opening. Ask yourself who was already standing there. Now the uncomfortable part. This system isn't likely to change soon. Modern economies are built on debt. Debt requires confidence. Confidence requires liquidity. And liquidity comes from money creation. The question isn't whether governments will print money again. They will. The question is who will be positioned closest to the door next time. Because the gap between those who understand this and those who don't isn't about intelligence. It's about awareness. So here's the final thought. If money is created by policy, distributed by institutions, and absorbed by assets, what does that say about who the system is really designed to protect? And, more importantly, where do you stand when the next wave of new money enters the system?